of the boom trade, of how we set up the show to begin with today. Jason Snipe, you trim Netflix, you buy BlackRock. Is that expressing that view?
So absolutely, I agree with most of the points that were mentioned earlier. If I'm thinking about GDP growth was 4% last quarter. We expected annualized to be up at least 7% this year, which is the highest number since 1984. When I look at the moves that we've made recently, and I look at Netflix, listen, I love Netflix, love the company, love the content, and they had a nice sub beat in earnings this season. But what I do think as the distribution of the vaccine accelerates and widely available by May, I think those subs will be harder to grow. And I think the stock has had sensitivity to net additions on subs, which makes sense. And I just think they'll be harder to come by going forward. When I look at AutoZone, I do think travel, the road trips, the do-it-yourself names, I think will continue to do decent. But I think people will be flying more than they'll be taking road trips come the summer. So, and that has a lot to do with the distribution of the vaccine and how it's widely available. And then as it relates to BlackRock, Joe mentioned the financials. I think financials just has been running since November. BlackRock, the largest ETF provider in the marketplace, like the acquisition of Perio in November of last year, will continue to expand their reach in the retail SMA market. I just think it's just a great buy here, and we decide to hop in.
So, Steph, can you make the argument that the base case is a boom and rates up higher than they are now, and that you need to be positioned accordingly? You sold Facebook, okay? So you've been trimming Facebook. Now you sold all out of Facebook, and you've gone more cyclical for tech into IBM. You've bought more IBM. So out of Facebook, more IBM.
Yeah, I mean, Facebook did what I wanted it to do, right? It was up 78% from the March lows. Great company, great franchise. But I made money and I took some gains there. I think IBM is the absolute opposite. The stock is down tremendously last year, and they're going through a transition with a new management team who's actually now focused on the right things, which was growth, AI, data analytics, blockchain, all of that kind of stuff. You get a 5% dividend yield, and it's trading about 10 times earnings. So I like that risk reward very much. It's very much out of favor. There's only 3 buys on the street on it. So, but just to go back to the boom point, this is all about an improving economy. That's what's driving rates. That's what's driving more inflation. The inflation break-evens are gradually continuing to rise. And that's because the stimulus is working. That's what everyone has said so far, right? And that's what we've been talking about for months on end. The stimulus is actually doing its job. Manufacturing, the data today was very, very strong. In terms of the market PMI, the ISM's is the highest since 2018. Chicago PMI is up 8 months in a row. Industrial production is running about 9% higher year over year. And then on the consumer side, which is 70% of the economy, personal income up 10% month over month, and a savings rate of 20.5% when your historical average is 5%. And so there's excess savings of $3 trillion that have been created since the March lows. So you can totally understand what the pent-up demand story is going to be. And some of these stocks are still down a lot, right? Some of these cyclicals are still down a lot. And so I have been talking about this for months, and about 70% of my portfolio is cyclically driven. I do not want to abandon some technology, but I also skew a little bit more cyclical within tech, meaning semi-cap equipment versus software.